how do you generate an idea and turn it into an actionable idea where the green light's on and you say, now I'm ready to trade, I'm ready to put position on?
Well, I think you hit the nail on the head in terms of having a template and something that's repeatable, because if you are just randomly shooting in the dark, every now and then you might come across a good idea.
Right.
But if you can have that process that allows you to take that process to different markets, to different sectors, you can build from the top down and then the bottom up, very solid ideas. The key component, I think, that I focused on was the qualitative components.
Yep.
So you've got the quantitative, the numbers, where they stand within a market, where they stand within a sector.
That's all mechanical and learnable, right?
Yeah, that's right.
Yeah.
I think the part that takes time and you need, it takes time, you've got to educate yourself, is the qualitative parts, working out what drives an industry, how lots of game theory type things come into it.
Sure.
People are going to raise prices, can they raise prices if their costs are going up? Those types of things.
Okay.
It's something you can educate yourself about, you can learn about industries. It's never written in stone.
Yeah. And it's always changing as well. It's dynamic, right?
Exactly. It's always changing. What happened for a sector or a company in one part of the cycle might not happen again, because there could be new competitors in. And as everyone talks about now, disruption from technology can have big impacts on these types of things. So it's just putting all those pieces of the puzzle together. And sometimes you put it together and you're not sure if you've got the right picture, and that's where the other components come in. Which is what retail investors often don't appreciate. And that's the trade structure that allows you to limit your risk, and trade timing, which says, okay, I've got a good idea, but is now the right time to be putting it on and making those assessments.
Okay, so one of the biggest challenges I see for retail traders is time management, because they've all got, full-time jobs, part-time jobs, running their own small, medium-sized businesses. We've all been on the professional side, we've all done this full time, and we can sit at desks and just constantly churn out ideas, and run big watch lists of really high quality ideas.
Yep.
Have you experienced that type of challenge with any of your mentees that you're speaking to now?
I have, and I guess the key thing is it's a function of time. What takes hours at the start to generate an idea, as the process is worked through and repeated over and over again, and as we've talked about with the template, the whole point is we've got something repeatable. So the time frame goes from hours and hours down to a much shorter time frame, to the point where you might see something in the news which is reflective of a sector that you might have looked at in the past, or an industry that you had been looking at, or maybe it's something on your watch list and you can say, okay, now's the time that I need to go and put that idea into action. So having no access to all the institutional data, all the research departments, is, in one sense, it's a burden that's gone, because you're looking to do this for yourself. You want to be independent. You want to generate your own ideas. The time component starts out this long. As you get more experienced, it shortens. Stood out beyond the resources world and beyond the Australian banks, which were the big names. There's a company called ResMed, which I got much of the Asian market involved in after doing some very deep dive work, which is not something that I would always do as a client facing. It's not, we've got a team of research analysts that do that. But I saw an opportunity in a company that had a catalyst coming up. ResMed is a sleep apnea mask making company. And the old days, if you had sleep apnea, or if a doctor thought you did, you had to go off to a sleep clinic, lie down and sleep, and it was like a hospital setting, tie you up to machines and away you go. The CDC in the US was looking at, and Medicaid were looking at ways of shortening that process, making it easier for people to get treatment. So I did a deep dive, found a whole bunch of online transcripts from those meetings, which were freely public available information, but no one else had seemed to find. And you read those and you knew with a great deal of certainty that they were going to make the decision to allow home sleep testing, which would be a huge positive for ResMed. So I've got clients that still, or former clients, that still hold that stock 10 years later. So it's those types of things, I guess, that help you stand out.
So these outsourced portfolios and in terms of your performance during that time, obviously it was good performance. What do you put that down to? Do you put that down to ideas and for example, this example that you've just given, your deep dive and research into these ideas? Do you put it down to that type of commitment to generating really high quality ideas all the time?
It's two components, which is two components of portfolio management and trading in general. One is the idea generation.
Yeah.
The other component is the discipline of how you structure the idea, but then your risk management.
Okay.
So risk management wasn't something that I was particularly strong at, but through trial and error and understanding what's going on with other clients, understanding my own weaknesses on that front, that wound up becoming a strong point. And I think idea generation remains my strong point.
Yeah.
But the risk management certainly helped. It's as important as idea generation.
Yeah.
And probably the part that retail investors least understand about the investment process.
Set the price of money.
Yeah.
It doesn't really matter why they're there. It doesn't matter who's put them there. All that matters is there is a price for money.
Yeah.
And you must understand that the price from money drives all other financial instruments.
Yeah.
Be those equities, be those commodities, be those foreign exchange rates.
Yeah.
That's key to understanding.
Okay. And when the price of money shifts, as we're seeing at the moment in the markets,
Absolutely. Liquidity
things
changes.
tend to happen.
Exactly.
What do you think about the current interest rate cycle? Where we've come from, where we are, where we're going? What impact do you think that's going to have in the broader market?
Well, I think the biggest question, and the billion-dollar question, if you like, are we at the end of an interest rate super cycle?
Sure.
I mean, really, since the 1980s, interest rates have been on a one-way track from the top left of the chart to the bottom right of the chart.
Yeah.
And they're at zero. Well, in real terms, so interest rates minus inflation, they are at zero.
Yeah.
So how much lower can they really go? Not much, I would argue.
Sure.
So I think people need to be in some way focused on what happens if we are moving into a higher interest rate environment, a higher real interest rate environment, meaning if inflation comes back. And there's a whole generation of traders out there who've never seen an interest rate rise. It's going to be a different thing for some of them to get their head around.
Yeah.
And it's probably going to lead to some fairly unexplained moves. Well, what look like unexplained moves in other asset classes, but if you can at least try and get an understanding of what they might be, I think you're going to be ahead of 90% of people out there.
Because at least you'll be on the front foot to enable you to do something.
Exactly.
If things start to happen and you understand why the moves are happening.
Exactly. If there's an unexplained move in something that you own or something that you're short, and you're then scrambling around trying to go back to a textbook, etc., to work out what the interest rate effect might be, frankly, you're going to be
behind. You're behind.
And we have a number of examples of that, even in the last 6 months. I mean, you and I spoke about it at length. When interest rates started backing up in January, the REIT sector, the real estate investment trust sector in the US, was down, I think, 15% from high to low.
It was even earlier. So it's all
started in December.
The top was in November.
Yeah, right.
Like towards the end of November, I think.
Right. And 15% in an index is a reasonable move.
Yeah.
And interestingly, it was only after you see that move that the mainstream press, the CNBCs and the Bloomberg TVs, etc., they start talking about it in January. But guess what? The move's already happened. There's not much value in that for a lot of people.
Yeah.
But I think, I know you were ahead of it, and we spoke about this at length, that, interest rates are starting to back up. It doesn't really matter why they're backing up.
Sure.
The fact is they are.
The price of money is changing.
Exactly. Yep. And that brings out all sorts of relative value arguments around, should you be owning dividend earning equities?
Yeah.
Should you be owning credit products? Should you be owning junk bonds, et cetera, et cetera, et cetera?
Yeah.
So that sort of that cost of money drives, in my opinion, every relative value argument out there, particularly on income generating instruments.
Absolutely.
And things like property, by the way. And things like car loans, and things like the cost of your mortgage.
There's many compounding elements, right?
Exactly. So I guess what I'm trying to tell people in my presentation here in London is, you don't need to be an expert on every single thing. You do need to have some core foundation in terms of just what are these things, what do these words mean. I always try and avoid semantics, because I think semantics are sometimes words that people just throw in the way to make themselves sound more intelligent than they already are.
Yeah.
We try and leave out the semantics, concentrate on the basics, and give people a core level of knowledge, and they can use that to then go and do some further reading and then go and do their own investigation. As opposed to putting their hands up and saying, oh, you know what, there's this big thing out there called the fixed income markets. It's very complex. It's very heavy in definitions. I'm not sure I can get my head around it, and giving up. You don't need to be like that. You can, frankly, spend a few hours, get in there, and then move on and at least have some good understanding.
And there's probably only in that market, 10 or 20 words or phrases that you really have to understand before you can understand what's really going on. It's not that complicated, right?
Not even. And look, some of the mathematics of it can be complicated. Absolutely. I'm not. Some of the minutiae in wholesale funding markets, that can be quite complex to understand, but you don't need to understand that.
That's not going to really affect a retail trader's portfolio.
No, that's not something you can make money out of, frankly. But if you're trading equities for a living and you don't know, or even as in your spare time, and you don't know where the 10-year note's trading, you need to know.
That's just crazy, of course. A retail trader, as a human, getting an edge has to be systematic. There has to be some sort of quantitative, systematic element to it, and some discipline there, because they have to go into a longer time horizon. Where do retail traders, in your opinion, in all probability, get an edge over the market?
Well, I think, if you kind of put yourself somewhere in between the high frequency quant type hedge funds and the plain like long only typical value manager who they look at years and years. So if you look at more, I guess what's referred to more as a swing trading style, which is a few months, 1 month to 6 months around there. I think you can find a lot of opportunities. But at the end of the day, though, you really have to mash your personality to your trading style. You can't necessarily take one approach, and it's not going to be a fit all. You have a kind of a model, if you will, or a process, but then you finesse it to your style. Because if you're not comfortable taking much risk, you shouldn't be trading the same thing as somebody who's very comfortable taking risk. That's kind of something that's been really useful for me, and something that took me a long time to learn is. You're not going to be successful until you matches your trading approach to your personality.
So, new guys who have literally never done anything in financial markets before, retail traders, open a trading account, put real money in there. It's part of their life savings, and obviously, like anybody else, they don't want to lose it. In terms of gaining a foundation, gaining an education in the first year or two, and then at the same time, obviously, finding where opportunities lie. This kind of like weekly to monthly time horizon, there's so many different styles and so many different ways that can retail traders can approach that kind of like 1 to 6 month horizon. So finding the personality within that time horizon, do you think it's possible for retail traders to be successful, like as a high percentage of them?
Well, not unless you have basically somebody holding your hand, at least in the beginning, because as soon as you put real money on the line, for a lot of retail traders, it's money that they don't want to lose, right? Nobody wants to lose, but I think, if you trade your own money versus millions of dollars of somebody else's money, when you trade your own money and you lose, and then you think about, oh man, I could have used that money for this or that, it is actually very difficult sometimes to deal with, especially in the beginning. So discipline is to me the most important thing in trading. But you need to have a process, and when you start out, you don't know how your trading style is going to fit, right, with the market. But you need somebody to help you out in the beginning, somebody to hold your hand, because there's so many mistakes that can be made in the beginning. And then the way this works is that you do a couple of mistakes, and then it kind of become a snowball. It just starts rolling down the hill, and before you know it, you blew out of half your account, and you don't really know what happened. You're like, oh, what just happened?
And nobody wants to blow half their account, right?
Right, and it's all about understanding risk management and discipline. Trading is a lot more complicated, really, than what you read in any book you can buy, because at the end of the day, it's all about how you are emotionally and how you control your emotions. So if you trade a little, some sim account, you might do great, but you don't have the emotional impact, which is huge. And you know, especially when you lose, because you will lose on multiple trades. You know, how you then react to those losses. And that is, I think, where it's really important to have somebody you can go to for help, and you know, somebody can kind of guide you on the right path. But then eventually you develop your own style, and you become self-independent. But that, you know, the learning curve can take some getting used to, and it can be really expensive to get to that point unless you have somebody who can guide you down the right path, I think.
You've joined the Institute.
Yes.
And you've actually mentored quite a few people already, outside the region and inside the region.
Correct.
The guys that you've been mentoring, obviously this is the first time for you mentoring retail traders and not mentoring professional traders like you've done for many years inside the industry. What do you think the key differences are between the way retail traders approach the market and professional traders? Because you hit on a point about the way retail traders trade in the MENA region, and they always seem to sell at the bottom and buy at the top. Clearly that's an issue. But the guys you've been mentoring, what have you picked up on so far? Have you seen any major issues that you believe retail need fixing across your mentoring programs? How does it compare to professional traders?
I think the number one issue is about having an investment process.
Okay.
The lack of any discipline in your investment means you're just a cowboy. You're shooting everywhere, hoping that one of them is gonna be a bullseye. Probability of that happening are slim. You may make one great trade, but if you're failing 9 out of 10 times, you're not going to perform. That's the main focus. And with the mentees that I've been talking to over the while since I've joined the Institute, these guys, the main thing that I applaud them for is their love for learning. They're here to improve their trading skills. Already they're getting out of that retail mentality by understanding that there's something that they don't know. They want to develop, they want to learn from an institutionalized sort of method of investing. And that's what we spend most of the time talking about, is how to have a process, how to apply it, how to generate trading ideas, how to protect yourself in times when volatility goes up drastically. How do you benefit from that? On top of that, I think that's the key difference.
So having a systematic process that's basically repeatable.
Absolutely, and on top of that, having a systematic approach is one part of it. The second part is really focusing on the fundamentals, as opposed to focusing on what your friend told you, or what you heard from your neighbor, or what you've read in the paper. Something that you've read in the paper.
Or what a chart did 5 minutes ago.
It's just too, or it broke a certain line. That means it's going to go to the next level. But based on what? It's not a process, essentially. So that's what we focus on: investment process, systematic, and fundamentals. Really digging into the company, understanding what is this business that you're buying, essentially. What's driving the economy?
So what's interesting about that is, from our perspective, a really typical outlook of retail traders from a guy on the institutional or professional side. It's a common thread of not having a systematic investment process for retail traders globally. In the Middle East, in my opinion, retail traders actually have a much tougher job, because, as you alluded to, the correlation effects with commodities in their region they're so strong.
You're known for those.
Yes. In your career, you've obviously been quite successful, but there's clearly been some shockers and bad situations along the way. Otherwise, you just wouldn't have learned, and you wouldn't have got the returns over the many years you've had.
Absolutely.
Give me something from left field.
Sure.
Give me a shocking trade that you've been involved in, and you've completely lost your shirt.
I will. There was one that I can never forget. So it's, for me, it's always at the top of my head because it's a trade that I might as well, if I could paint it, I would, and then just hang it on the office, just a chart of how this one went. So there was a telco listed in Saudi Arabia, which was the darling of the market. Essentially, it was a crown jewel across all of my portfolios. It was a very solid company.
What's the name?
This was Mobily.
Who?
Mobily is the stock. Etihad Salat is the other name it's known as. And the stock was, had I think at the time it was almost a 7% yield, annual, very strong, positive cash flows, predictable earnings that were just growing quarter on quarter. And suddenly they reported one quarter a couple of years ago, almost 3 years ago now actually, that they had falsely reported their earnings for the past year and a half.
Oh, that's death.
So
that's the killer.
Yeah, that's it. I mean, the stock did not go to zero, but I don't understand why it didn't go. It stayed a little bit high, a little bit above that. Luckily, I was able to sell. I mean, that's when you sell at market as opposed to selling using a limit order. You're just trying to get out as fast as you can. You will take any loss because you don't know what this company's looking like.
It's just about what you can get out for.
At what price can I sell at? Just get me out. So we're on the phone with our brokers on Bloomberg, just trying to message, and everybody's trying to do the same. And what's difficult about that region is you have limits every day. So the market cannot, circuit breakers, precisely. The market cannot fall beneath 10%. So if you don't get out in the very first few seconds that the market is open, forget about it. For the rest of the day, there are just offers and no bids. 1 day, 2 days, 3 days. So, I exited with a 30% loss, which was very painful. And mind you, this was a stock that was across...
That's a core position across all portfolios.
Across all portfolios.
My God.
So nobody was spared. And what hedge? Because this was a no-brainer, essentially. That was the toughest lesson for me, is that audit your numbers, look at the fundamentals, understand the company, sit with management often, and there's no such thing as a stock that's going to remain great forever. Stories change. And you need to adapt very quickly.
Well, there's a big lesson for retail there. It happens to professional traders too, right? So I think a lot of retail traders can take heart from something like that. The young guys, you can, because of your age and your successes so far, the young guys can actually, it's easy for them to relate to a guy like yourself than a much older guy. And even the a middle-aged guy, you've got the great experience and they can understand it. But for young guys, understanding stuff like that, is really key, right?
It's what's been great about the mentoring programs is I've developed friendships with the mentees.
What do you find from your experience retail traders struggle with? What do they, when they start out, what difficulties do you think they face, and how do they overcome them? How do you help them overcome these difficulties?
I think it's basically twofold. One of the really basic things is the PTM is really comprehensive, and it's a methodology. So, but it actually requires quite a lot of time devotion. So time management is definitely an issue. But the really big thing is the process, because almost all of the guys that come to us, a lot of them have actually tried trading before. Unfortunately, most of them not successfully. And a large part of that is down to the fact that, understandably, they've not been taught a process, or they haven't learned a process. And so what the PTM does, and then what the mentoring continues to do, is impart a process and a methodology. And so it's adopting that process and getting into that way of approaching things and thinking about everything that they need to focus on. It's about getting them into that kind of routine and habit. And once they've got that, that's when the confidence comes, because they understand what the process is, why we structure the process in the way that we do, and they can see how that feeds through to generating a portfolio and good returns and good risk management. So really it's those two things, the time management aspect and getting hold of the process.
Yeah, so I guess a lot of, obviously, retail traders, they're not giving up their day jobs or not closing down their businesses if they're self-employed, and then just starting a whole new career in something that they don't know if they're really any good at or if they like necessarily. So to begin with, retail traders, they're still running their lives in the same way, but I guess trying to fit in this new skill set, this new hobby, if you like, of learning the financial markets, how to trade, how to manage portfolios successfully. But I guess trying to fit that kind of 8 to 12 hour minimum weekly commitment into their diaries and focusing on all the right things. So that's obviously something that they struggle with to begin with and then get used to after, as you mentioned, a couple of months. What do you find retail traders are good at? Because actually earlier you mentioned something quite interesting about being on the trading floors. You're sitting in this kind of vortex of information flow. And the way the market's actually evolved, the internet has actually been the great leveler. After you left that side of the industry, can actually access all of this information now. They just kind of need to know where to look and how to interpret it. Is there any advantage, or are retail traders better or good at anything that you think, compared to the professional side, they can actually leverage? It's for retail traders where they've actually got great flexibility to go out, generate ideas, and actually have access to a huge opportunity set.
Absolutely. And obviously this is part of what we do with the PTM and the mentoring, in terms of we show people how to find it, where to find it, and free. You know, it doesn't cost you. It's freely available, as in widely available and no cost. So I mean that is a tremendously empowering thing, and actually that gives a retail trader the ability to, in some respects, emulate what we did as professionals, and that's the whole idea, isn't it?
Yeah. So what I find amazing, actually, this flexibility that retail traders have, and all the guys who come through the mentoring programs, it kind of creates a foundation that enables these guys to go out and generate ideas that wouldn't necessarily be generated by guys who are sitting in this closed environment at investment banks or even at hedge funds. This is obviously something they're quite good at. What's your experience of that?
Yeah, I think that I mean, first of all, this is probably going to sound a bit trite, but I haven't had a single student yet who I've thought at the
So the risk management is to ensure that you get the best returns from your trades that is possible, which means maximising your winners and cutting the losing trades. Either getting stopped out. If you get stopped out, you have to remain emotionless, be objective. You hit your target, your stop loss. You hit your stop loss. Exit the position. Cut it as quickly and as effectively as you can.
Can you think of very quick? Can you think of a practical example of this in your career?
Yeah, practical example. Obviously, I've been stopped out numerous occasions, and I know the process that you have to go through. Because anybody puts on a trade they have an idea behind it. So by getting stopped out, you are admitting to yourself that you are wrong. Maybe just in the short term, but you are wrong. And that is very, very difficult to learn. How to do that, once you've done it, that's where you take the emotion out of it, and you've lost the maximum amount of money that you want to lose in the trade. That's when you cut the position. That's your stop loss. Examples for myself where you need to be disciplined and maintain your objectivity. Good example, I was short some telecoms. I got short Deutsche Telekom a long time ago when I was trading at Goldman, and I knew the hedge funds who were buying it from me would be buying it in multiple places, taking the market higher. So rather than watch tick for tick and get squeezed out of the position, I just went for a walk for 10-15 minutes, came back, stock had moved 3% against me and came right back down again, and I maintained my objectivity. That's a lesson for myself.
Right, and it's important.
It's absolutely essential, absolutely essential. before you put a trade on, you need to know what your stop loss is. And if your stop loss is triggered, you execute the position, you exit the position and get out. And this happens to every single trader. Every trader has traded and they've been successful will have been stopped out of positions. Stop losses and the discipline are absolutely key. And this is where the emotional detachment is absolutely key because you need to have the emotional detachment from your P&L. Okay, you're realizing a loss, but you need to be able to switch that off and exit the position. A good example of that is when we were on the desk at Goldman. Okay. I think somewhere around about sort of 2000, 2001, right. Just as the NASDAQ bubble started to burst. Okay. We had the peak. Subsequently, so it looked as though that we'd hit a peak a few months later, and obviously in a bear market, there's going to be some vicious squeezes along the way. Nothing ever goes up or down a straight line.
So that's a massive short on it.
So I remember one day we were very, very short in the back book. Yeah. Market was squeezing and really sort of gapping to the upside. We were getting taken short everything in the front book. And,
I remember this; it was painful.
Yeah, I think we were down a lot of money. I think at one stage we were short probably about $500 million.
Jesus, yes.
About $500 million, and we.
So I think it was $400 million.
Yeah.
At lunchtime.
Yeah, at lunchtime. Yeah.
Oh my God. Yeah.
Lunch wasn't too good that day. And we thought, okay, what do we do? This is the emotional detachment. We could panic and cover the whole lot. We came in short. Our proprietary view was to be short, that the markets were going down, our stocks were going down, we were trading telecoms and technology, it's clearly higher beta in that environment. So market goes down 2%, some of these stocks are going anywhere between 5 and 10%, and vice versa. And the short squeeze that we're seeing, market was up 1-2%.
Vicious moves.
Our shorts are up anywhere between 2 and 5%. That's the nature of the beast, that's the volatility, which, like I said, is opportunity, but clearly there's also P&L swings associated with that. Yeah. So we were short, we were bearish, got taken short by a lot of guys buying stocks either to short cover or to have a punt and sort of think that the market's turned and everything's going back to the highs. We didn't think so. However, lunchtime we had a conversation. We're very short.
I remember this conversation. It was actually a horrible conversation to have.
Well, we could have panicked. We could have covered the whole lot because we were losing money. That wasn't our view. We could have panicked and been a rabbit in the headlights, frozen, unable to do anything. Equally as bad, because we were there as market makers, we were there to provide liquidity to institutions, and that was our job. Yeah. We needed to be able to continue to trade. The only way we could do this, as you remember, is that we bought Euro stocks. Yes. And before we did it, we bought the Euro stocks because we needed to reduce the risk.
I literally remember having this conversation where we're sitting next to each other, and we literally looked at each other and said, "What the hell do we do here? We have to do something." Yep. And we don't like what we're doing, but we have to do it. And that's about staying in motion, I guess, staying objective and staying in motion, doing something. We had to be unemotional and detached from our P&L and our risk. Well, we just looked exclusively at the risk. We were too short. We had to reduce that because we needed to stay in the game. We bought the Euro stocks, and we both knew this was going to be the high of the day. Subsequently, it turned out it literally was the high of the day. I think we printed the high of the day in Euro stocks.
Somebody has to. Yeah. However, when the market started to turn again in the afternoon, what we did do was we increased the positions and increased the shorts. That, I would say, is textbook of how to trade. We didn't increase the shorts on the way up. We waited until we reduced the risk to get it back in motion. Obviously, we saw the Euro stocks at a loss because our view was still to be short. But when we had got confirmation in our own minds that the trade was now going to work, then we increased it.
And at the end of the day, we actually came out of the day up.
I think we were up small,
that was insane.
But then over the next 2 days, we made a very big amount of money.
So in terms of objectivity, the risk in that scenario, it's almost like a textbook case study of emotional detachment, right?
Very much so.
Because the objectivity and the risk management practices that we were implementing right at those moments, it was actually all about doing the right thing at the right time. And that's actually a skill set that you can't learn unless you're in it and doing it for real with real money, right?
Absolutely.